Hello and good afternoon. I welcome you to today's weekly market outlook here for Admiral Markets. My name is Jens Klatt and I will be the moderator here for the upcoming, 45 minutes, I think. And as usual, we want to have a look at the markets and what to expect in the upcoming week. So next week, obviously, will be, or all eyes will be on the Brexit vote in the UK Parliament. And probably some of you have had a look here at the developments in pound sterling over the last days, probably over the last minutes, in fact. And we've seen a spike up to 128 and above that level. Which came hand in hand with a news hitting the wire that the Brexit let's call it deadline, or once the exit from Great Britain out of the European Union will be finished. The date here was the 29th of March. Will probably be delayed, and that was a bullish spike, which is of surprise for some probably. And we definitely want to have a look at this, but also we want to have a look at several other developments around the US, especially the still ongoing shutdown. The tweet from Donald Trump yesterday that he won't be in Davos this year in Switzerland at the World Economic Forum here, taking place from the 22nd of January till the 25th. This is in fact a big deal, especially when looking at equity markets who didn't really pay attention to that and just kept on moving higher, driven by the comments from Jay Powell last week on Friday. Why do I say that? Well, it shows that the shutdown is likely to continue till that date, so another 2 weeks, probably even beyond that. And there's also something worth mentioning in this context. I mean, we're talking about Trump not being there, and so there is no real chance that there will be ongoing discussions around the conflict in terms of trade between the US and China. And all this, if we're looking at equities, then seeing them pushing higher and not seeming to care about all these developments is something to be a little, let's say, worried about. And that's also something we want to have a look at in the upcoming minutes. Before we start, we want to have here a look at the risk disclaimer. Very, very important. Please understand that trading with financial instruments offered by Admiral Markets carry a high level of risk and may not be suitable for all investors due to their complex nature. For the complete risk disclaimer, please feel free. I don't go through all this right now, but please feel free to check out the website from Admiral and check the risk disclaimer there. What we definitely have to look at here is now the differentiation between retail clients and professional clients after the so-called ESMA decision. It's in place since August 2018. So why is it noteworthy? Has to do with now leverage restriction for retail clients with a maximum leverage on Forex majors here of 1 to 30. This is, for example, Euro USD and minor currency pairs like, for example, GBP Australian dollar, for example. Now having a max leverage of up to 1 to 20. And also this 1 to 20 max leverage here comes into play when it comes to trading CFDs like DAX 30, for example, or also gold, for example, also something we have to have a look at, especially when it comes to the developments around the US dollar and knowing about the negative correlation between gold and the US dollar. So meaning USD going down, usually gold should be expected to go up here. But before we start with this now, the interesting note in this context, so there's a differentiation, as already mentioned, between retail clients and professional clients. So with the leverage restriction, professional clients, for example, do not have such a leverage restriction. The interesting thing now is that Admiral Markets is offering also some kind of negative balance protection up to 50,000 pounds sterling according to the policy from Admiral Markets, while retail clients, for example, here have an unlimited protection against negative balances. Also here, feel free for further information to reach out to Admiral Markets and their customer support. They feel free and happy. You feel free to contact them, and they are happy to help you out here. So this is me, the face to the voice you're currently listening to. This is the question: why Admiral Markets? So currently, I'm sitting here in Berlin, Germany. And what I can say is that in Germany, Admiral Markets is usually referred to as the so-called DAX expert. Among also professional traders, Admiral Markets has a very, very high reputation here, especially in terms of a typical spread. So very, very favorable trading conditions for traders. One big reason to definitely check out the offering from Admiral Markets. Another is the FX offering offered by Admiral Markets, now with reduced spreads also. All information is available on the website. And also, definitely something to consider when looking for a broker is where is the broker regulated, respectively, how big is the broker? And in fact, Admiral Markets is growing and among the biggest probably brokers among the globe. Registered and regulated, for example, by the FCA, and also regulated, for example, by the CISEC in Europe here, so fulfilling all regulative standards here. Also very interesting, they have an office here, for example, and also a regulation in Australia, in Chile, for example. So if you're interested in the offerings here from Admiral Markets, also feel free to reach out to Admiral directly. So these are the contact details. And then let's have a look here at the agenda before we start through. So the questions we want to answer today are, what are the key economic events in the coming trading week? What's the current bias in the FX, equity, and commodity markets? And then, sure, which trading opportunities may arise? And with this in mind, we'll now have a look here right into the price action in the DAX, especially in this context. And seeing that the DAX is currently seeing some intraday pressure. In fact, it's not coming as a surprise. So already in the morning, I have to say I expected this push here lower. The question is this a sustainable move? So will it last? Yesterday, for example, the DAX also started. Yeah, it was okay. Stabilized into the day and then into the evening here, saw a push higher. And the reason for this push higher was mainly driven by the US equity market. So you have the feeling that US equity markets currently are not only seeing stabilization or momentum here, let's say, backed by the comments from Jay Powell last week on Friday, when he mentioned that the Fed carefully listens to the markets and is also very flexible in their monetary policy approach. In between the lines, you can clearly read after the comments, especially in October, when Powell, respectively the Fed, said that they consider current rate levels here way below the neutral rate, which was interpreted as they will further aggressive, probably compared to the other G7, G8 currencies, or in the G7, G8 currency universe, there will be more rate hikes there are more rate hikes to be expected. And this started the higher volatility than in equity markets in the US, but also over here in Germany, for example. And you could definitely see some pressure forming. And the Fed, especially after the last rate decision here in December, it was clear that they have to somehow adjust their approach here, especially not only in terms of hiking rates, but also in terms of balance sheet reduction, which Powell meant here to run on autopilot here. And you definitely have to say it's Fed driven here, this higher volatility, but it also has surely to do with the policy from the Trump administration, the U.S. shutdown, but especially the trade war, and you can't really rule out here that this is probably the main driver. Then Stephen Mnuchin, that was shortly before Christmas, came in and was talking about assuring, when calling the CEOs here on Wall Street, the six biggest investment banks, that enough liquidity is available, and also bringing in the plunge protection team. No one was really talking about a crisis. It was just let's probably switch over first here to the to the Dow Jones. No one was really talking about the crisis. Yeah, sure, that was some pressure which formed here, and we dropped below the opening price of 2018 in December. Here, we dropped below the simple moving average 200, and yeah, sure. It wasn't what you should have expected, especially in a usually very positive seasonal environment. So everyone knows about the so-called Christmas rally, and now we see equities being under pressure. But no one was really talking about a problem or a big issue here forming. Probably some had it in their somewhere in their mind, but it wasn't really present, let's say. And then München comes up and tweets. It was just a tweet, and comes up with saying, "Hey, I talked to the to big investment banks, made sure that enough liquidity is there. By the way, I also planned to talk to the plunge protection team, which is usually there as as a stabilizer, let's call it here, of equity markets when really there's lots of pressure." And was the plunge protection team was founded in 1988. That was shortly after the big crash in October 1987. So no one was talking about a problem, and then the U.S. Treasury comes out and is talking about a problem, and everyone was like, "Oh, there's a problem." But the thing is that markets stabilized shortly after, but not, they stabilized, but not necessarily because market participants are now convinced that problems are solved, but it's more plunge protection driven, let's call it here. This push higher, especially on the 26th. And then the comments from Fed Powell last week, it was, we can call it to some extent probably a Powell put. Everyone somehow knows about the Fed put. It's the Fed stepping in once markets get choppy, or let's say markets start to get nervous. And Greenspan, for example, was the first. Everyone knows somehow about the Greenspan put, and the Bernanke put was put into play. That was especially around the QE time, around 10 years ago during the financial crisis. And now the comments from Powell are somehow interpreted as a Powell put, or can be interpreted, that the Fed is willing to also cut rates probably. And this, in combination with the plunge protection team, is driving prices higher, but it's not fundamentally driven. And this is the problem here, and especially when now seeing since last Friday there hasn't been a down day. And so this whole push higher here, especially when facing the U.S. shutdown, when looking at the comments from Trump. By the way, that's probably of interest here. So first of all, this is around the Brexit. We'll have a look at pound sterling a little later, but first of all, let's have a look here at the comment here from Donald Trump. So because of the Democrats' intransigence, that was, by the way, a word when several people on social media started to doubt whether this tweet is really from Trump, but that's not just saying. On border security and the great importance of safety for our nation, I'm respectfully canceling my very important trip to Davos, Switzerland, for the World Economic Forum. My warmest regards and apologies, blah, blah, blah. The thing about this tweet here from Trump is, as I already said, the thing is that it shows that the shutdown is most likely to continue. There won't be any talks with the Chinese too. And now let's especially have a look here at the U.S. shutdown and why this is of interest. Therefore, we have to click here at this article. It's on Yahoo Finance. By the way, let me just, can I stop this here? Yeah. So why is this of interest? Well, it's here. Fitch warns of U.S. credit rating downgrade as shutdown continues. So the U.S. hitting the debt ceiling is highly likely based on that. And the longer this shutdown continues, the more likely it is that this debt ceiling is finally reached at the beginning of March, I think. Here, the U.S. is slated to hit its debt ceiling on March 1st if the government doesn't take action. And so far, it really seems as if the shutdown will continue. And not only that, there's also some now some trouble happening behind the scenes, especially from an not regulatory perspective, but also in terms of how the government can function without being paid, and this is definitely something which we have to worry about. But let's come back here at the potential downgrading. So banks usually have to put insurance up if they want to borrow money from a central bank. Let's put it very, very easy in this context. And usually they put up collateral, let's call it, or insurance here, in terms of US Treasuries, for example. Now, if there is such a downgrading happening, this is taking away liquidity here from the markets, since banks now have to put up more insurance slash collateral here to borrow money, which probably accelerates a potential push on the downside in an already illiquid market environment which we face. So such a downgrading, or at least the chances of such a downgrading, are a serious threat here to the markets. And with this in mind, when looking especially at this, in my opinion, difficult push higher and only front protection driven or manipulative push higher, stabilizing the markets, it becomes a complete different nature, let's say. And when looking at it from a technical perspective, we can also see that there is a quite significant region of resistance here to be found on the upside, in the region around the 50% retracement level from the all-time highs to the lows here from 2018. And so with this in mind, it's definitely worth to be at least careful when taking long engagements in US equities in this context. And now let's come back to the, in our case, probably more interesting market. It's the DAX 30. So first of all, we now reached the region around 11,000 points. Yes, that was also something we mentioned in our weekly market outlook last week, but we didn't make it out of this trend channel. And so, in fact, we just tested it, or we didn't even reach 11,000 points, in fact, and now face some trouble to gain further momentum on the upside. That's also something you can clearly spot here when looking at the hourly chart. So what you can clearly spot is a potential bearish divergence forming, meaning the market makes new highs, but it's not confirming them anymore. Here, for example, in this oscillator I usually use for this purpose, it's the RSI 14. And so if you combine this, this is a first indication, at least from a technical perspective, that the market is losing some momentum on the upside. So with this in mind, this push lower now on an intraday chart here is not such a big surprise. So in fact here, as you can see, the market made continually newer lows into the day, and is, by the way, also trading here below the exponential moving average 50 on a 5-minute time frame. For me, this is the trend filter on an intraday basis. Usually the market really respects this moving average here as a moving support, respectively resistance line over the intraday, over an intraday time frame. Works quite well, in fact. And as you can see here, for example, there's also been a push here out of this in this case open range on the downside. And then once the market retraced, it found resistance here at this EMA 50. So the question now is, what will the US markets deliver opening in around 2 hours from now? If there is now pressure coming into the markets, not seeing really huge pressure, but this is the thing. We have to remember that the market environment is very, very illiquid right now. So any push on the downside can easily accelerate, and there's kind of a domino effect then happening. And if this really takes place, there's quite significant pressure to be expected from US equity markets. And there are several reasons to expect this, as already shown or described here from, for example, the shutdown perspective, potential downgrading and all this. And so with this in mind, there's a good chance that then the DAX will probably push significantly lower here and go probably into the weekly close for a test of 10,800 points. And if we break below this level, not sure if we will make it today, but if we break below this level, then into the start of next week, there's further losses to be expected, which could easily bring us as low as 10,660, 680, 700 points here on the downside. So, and then now the thing comes into play. This is definitely relevant here, beside the pressure probably coming from the US equity markets, and why the DAX has a serious chance here to see another test then over the, not necessarily DAX days, but probably next weeks of the lows here of 2018 around 10,280 points, respectively, the psychological relevant level around 10,000 points. There's also the Yeah, well, we have to call it a mess here around the Brexit. I think this definitely is okay to call it a mess. So in this context, now we have to look to Great Britain and to the vote taking place, the Brexit vote taking place on Tuesday here. On the 15th of January. And so, in fact, I'm still not really sure whether this vote will really take place. So there's still some speculation, some rumors that it will be delayed a second time. So in fact, this vote should have taken place already around 1 month ago in December. I think was on the 10th, if I'm not mistaken. Yeah, I think, in fact, yes, I think it was the 10th of December, and it was delayed then shortly before. And the reason was because Theresa May shouldn't expect here the Brexit deal she negotiated with the EU will go through. So, in fact, now on Tuesday we have a vote taking place, but chances are very low that really this deal will make it through the UK Parliament. If this deal falls apart, it's very unlikely that there will be a deal found at all between the EU and Great Britain, so that there is this, well, let's call it a hard Brexit scenario then forming. Now the interesting thing is, and this is the main reason for this push higher, so this is a daily chart, but if you look at the 50-minute chart, you will definitely see the push here towards and above 128. 1 second. So taking some time. La, 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 la. You will see a bullish spike. So there we go. So there you have it. You can see it here. That was the candle. Is around, yeah, one hour ago. We traded below 128, so around 127.60, 127.70, and then there was this spike higher, which pushed us not really 100 pips, but it was 80 pips higher. And so the question now comes to mind: why? What was the driver for this push higher? And here, oh wait, let me just close these tabs here. So the reason for that was that there is now cabinet ministers reveal that the delay to Brexit may be on its way. So, which means there's the quote. Certainly, if there was defeat on Tuesday and it took some time before it got resolved, it's hard to see how we can get all the legislation through by March 29th. So, meaning nothing more than it's a high chance, as already pointed out, that there will be a no for the deal which May negotiated here with the EU. So this means chances are high that no real solution will be, or that no one really knows what the future will look like. So there will be a delay here of this deadline of the 29th of March, which means it's giving, first of all, more time to find a solution which is in favor not only for Great Britain but also for Europe. And we have to remember, I mean, they play hardball, let's say, from the EU, from Brussels, so they are not willing to make any or to give any, or to let the, let's put it that way, to let UK cherry picking something, but they're just like, okay, this is the deal, you take it or you leave it. The thing is that I think Brussels is definitely it's of interest to find a solution with Great Britain, because especially of the quite tight trade relationship between the UK and Germany as the biggest economy of Europe, and also facing with the UK its fourth biggest trading partner worldwide, after China, after the US, after France, and then UK coming in on fourth place based on data from Statista here. And so with this in mind, it's definitely of interest also for Brussels and the European Union, even though they just can't step back from their, let's call it hardball approach here. And the reason for that is because this would open the door for other countries somehow, yeah, getting the chance then to blackmail Brussels and go for a referendum here too. I'm trying to really blackmail Brussels, saying, okay, we'll leave the European Union if you do not do this or that for us. And to avoid such a chance here, they have to go with this approach, even though this delay, even though some might probably argue, okay, but the EU, if they do not, I think it's given by law, this deadline also by European law. The question is really, can they really continue with their hardball approach? I think, based on the trade relationships between the UK and Germany, it's unlikely, and I think such a delay would point to a more favorable solution, not only for the UK and a more favorable deal for the UK, but also for the EU itself. And this is the reason why the first push was higher. Plus, we have to add in this context, I think, something else. The longer it takes now to find a solution, the higher the chances, in my opinion, that there will be a second referendum taking place. A second referendum means nothing more than chances are quite high that there will be a no to a Brexit then, and there will be no Brexit at all. So if you take those two chances here, this perfectly explains, in my opinion, why there was such a push higher here in pound sterling, even though, sure, we have to wait if this move is sustainable or not. And yeah, so that's really all I have to say about pound sterling. So in fact, based on this Brexit vote, and this complete mess taking place around the Brexit right now, especially in the UK politics, pound sterling is a currency I really don't want to be long here, or aggressively long, especially over the next days. I wait for this vote to happen, in which direction pound sterling points then, and then probably I'm willing to take further positions here. Long positions, in my opinion, are to be favored if we break out of this down channel here on the upside. If we go above 128, 128.30, hopefully on a closing price, on a daily closing price, then, and then probably we can see further gains, bringing us back up to 132, 132.50, probably 133 over the next weeks. But this is definitely far away. On the other hand, if we don't make it out of this channel, there's a further push on the downside likely, bringing us at least down to the flash crash lows around 124.30, and then probably even lower, with the first target to be found around 121. But again, we just have to wait in which direction this Brexit vote will guide us, and also in which direction then pound sterling will react, if we see the push on the upside or if we see the push on the downside. So that's it on pound sterling. I think what's of more interest, in my opinion, is the picture in Euro USD. And here, there's something really interesting happening right now. We've seen the break out of this trading range we mentioned several times over the last weeks, was between 112 and 115. And the push higher here occurred on Wednesday. The main driver for this push higher can be found in a comment from here, a Fed member from Atlanta. So his name is Bostich, and he said that policy could move in either direction. He's open to rate cut if the downside risks all come to bear. The link, I don't want to publish it right here, but this is from a Reuters interview he gave on Wednesday, and it will be linked here in the weekly market outlook, which will be published then in written form on Monday. Yes, so around probably 10 a.m. German time, so CET then. You will find it in among the traders block. This is here, by the way. This is the same region below analytics, where you also can find the Forex calendar. We'll have to look at this here too in a few seconds, and also at today's inflation data, by the way. That's also something of interest, something which is of interest here. And there is also the traders block section. So I definitely invite you to have a look here. There's also an outlook for gold, something we'll have a look at here. Also, not only for the next week of trading, but also for today, based on this inflation data and the next seasonal pattern coming into play. But before we start with this, let's have a look here again at EURUSD, the breakout on the upside, driven by the comments from Bostich. So what does he say? Well, he's saying nothing more than we have to wait, see how markets react now over the next month, especially equity markets, to the last rate hike. If volatility continues to stay elevated, well, further rate hikes are unlikely. And in fact, between the lines, you can also see that he's bringing in rate cuts already in play, or he's bringing them up, and markets should prepare for such a rate cut. In fact, the reaction was really interesting. And not only that the US dollar saw some selling pressure, but it's also true that when looking here at the Fed Watch tool, which measures the probability of a rate hike of the Fed, for whatever month you like. And now I went to December here already. You can see that the probability, and this is the current rate. So this structure here shows the current rate. So we're talking about December 2019. You can see that currently chances are at around 16 to 70% among market participants that there will be one rate hike. So we're talking about the current rate level at 225 to 250 basis points, and then one rate hike of 25 basis points brings us here to 250 to 275. Currently, in fact, the majority of market participants, in fact, with 70%, 72%, sees no rate hike, while another 11% sees a rate cut currently. So this said, it's no big surprise to see the US dollar being under pressure, and in this case then seeing the euro breaking out here. In fact, bringing the overall advantage now on the long side, in my opinion. The breakout above 115 activates as a target on the upside 116, 116.30 here. This is the region around the highs in October, and if we break above that level, there's further gains possible up to 118 to 1850. Nevertheless, the thing is, even though long engagement should be favored here after this breakout, I don't want to be long in the euro after this breakout here before the Brexit vote has taken place next on Tuesday. Again, the ties are quite clear between the European Union and Great Britain, and if there is a no, and if there are signs forming on the horizon that there is also a no deal scenario becoming likelier, or becoming probably the most likely outcome, this would definitely have a negative impact on the euro. And you should expect euro to drop back below 115 and into its range. And probably not only that, but over the next days of trading then, or weeks probably, it going euro going down to 112. There's also something from a seasonal perspective worth noting here. The euro has seen since its installment from 1998 onwards, usually a weak first quarter. So that's, from a seasonal perspective, also something to worry about when being aggressively long for several days, weeks, probably the euro, expecting gains. From a seasonal perspective, it's not the most favorable environment or window in which we find ourselves currently. By the way, I have just to have a look here. Okay, perfect. Yes. So what I did, I have a look at. I just had a look here if I'm running the recording, and yes, I do. So there's a recording, and you will find the recording also in a few minutes to probably several hours later in the YouTube channel from Admiral Markets. But I just had to make sure that there's a recording running, but everything's fine. So yeah, let's come back to the euro. So I don't want to be long before this Brexit vote, the euro, but let's put it that way. If there is a no, and the euro can nevertheless stabilize above 115, I consider this a sign of strength, and then long engagements in the euro become a serious option. And we should definitely think about long engagements. I think this definitely favors the long side in the euro, and further gains then up to the already mentioned levels here, 116, 118 are likely to happen, especially if the weakness in the US dollar continues, which is based on the US shutdown for the upcoming 2 weeks, then minimum after Trump canceled his trip to Davos, definitely an option. So, and yeah, so with this in mind, then being skeptical around the US dollar and probably seeing also some volatility, or volatility to probably ahead of us. Dollar JPY is also definitely worth giving a deeper look here. So why? Well, after the flash crash here, well, in general, the sequence after the dollar JPY topped here at the beginning of October, with the structure falling highs and falling lows, and dropping, especially here below 110, the overall advantage in dollar JPY, in my opinion, can be found on the upside. And after we've seen this push higher now, and dollar JPY seeing some trouble, gaining further momentum, in my opinion, chances are high that probably, especially if now another risk off hits the markets, and also here yields stay under pressure, especially. Well, this is of interest. This is really interesting, in fact. So will rates stay under pressure if there's a downgrading of the US? This is a very interesting question. So in fact, usually you should expect the demand of US Treasuries then to slow down. Usually expect the rates coming higher, and there's an interesting correlation between rates and dollar JPY, or in general. So JPY is a very yield sensitive currency based on the zero yield policy which the BOJ has since, I think, minimum 10 years, but I think it's more likely to go back into the 90s already, and see it for over 20 years then. And now the interesting thing about this is it really likely that dollar JPY sees a push lower? I think yes. I think usually you should, even though rates are likely to come up or push higher, then also to see JPY gaining momentum, gaining traction, based on the fact that usually market participants are very likely to reduce carry trades, which means capital backflows in the JPY, but also the Swiss franc, for example, taking place, and selling the affected currency, which is in this case the US dollar. So also from this perspective, I think it's fair to say that dollar JPY, even if rates rise, that then dollar JPY will see some losses here. But let's come to the technical side, back to the technical side. So interesting enough, when looking at the hourly chart, you can see that so far no real short trade was really triggered from a Dow theory perspective. But I think the trigger line, or the line in the sand here, can be found around 107.70 to 107.80, because if we drop below this level here, we then see a structure of falling highs and falling lows, which, by the way, activates then probably the region around 105.50 to 106, the region around the flash crash lows from the 2nd, respectively 3rd of January here. And this is definitely also something which should be of higher interest when trading, especially the FX markets. And so with this bearish outlook for dollar JPY, and in this case also yields potentially dropping, respectively, uncertainty staying high around the US shutdown, usually, and where not usually, but definitely you have to have a look also at gold here. So it's the 4-hour chart. Usually we look at the daily chart here, but today we want to have a look at the 4-hour chart. Reason for that is simple. I want to point out here this region around 1,275 to 277, above which we still trade, and I consider the line in the sand above which a push above 1,300 USD is very, very likely. So usually you have a negative correlation between gold and the dollar JPY, meaning if one rises, the other should drop, and the other way around. The reason can be found in yields, because if yields rise, gold becomes more unattractive as a asset which is not paying any yields at all, and then usually should drop, while dollar JPY should see a classic carry trade forming, meaning you borrow cheap JPY and then you buy from a yield perspective, the more attractive US dollar. And that's why the negative correlation then comes into play here. But let's come back to gold and today's inflation data, which will be published in around 45 to 50 minutes from now. So with the overall skeptical outlook, which I presented now over the last minutes here around the US dollar, and knowing about the negative correlation between the dollar and gold, usually you should then expect gold to push higher. And in fact, we are about to enter the next very, very positive seasonal period, a very positive seasonal period here over the last 20 years at least. So therefore, I've prepared here already the following seasonal bullish pattern, which occurred here between the 14th of January till the 5th of February over the last 20 years. So in fact, in 15 years, or 75% of the cases, gold gained on average 30.61 USD per ounce, while when it lost on average 12.86 USD per ounce. So it's a very, very profitable pattern. The only problem I currently have is that gold already looks quite extended. And this is something you can definitely spot here from a daily perspective a little better. It's very, very extended on the upside, and it has already shown some weakness here against 1,300 USD. So there's definitely supply coming into the market and holding gold back to push above this barrier. But, and this is the thing, if we push above that level rather sooner than later, and probably we are about to see such an attempt to break higher already today with US inflation data coming in, then I think there is a sharper move or a squeeze higher up to 1,305 to 1,308 USD quite likely. And this is one thing I already pointed out in the traders block here, so admiralmarkets.com, and then we go to analytics and click on the traders block, and you will see an article which was published already in the morning here. And obviously this is the article. So gold finds strong resistance 1,300, but US CPIs on Friday in focus. So the inflation data today is expected to come in at 2.2% here, year on year, core inflation, while inflation rate is expected to come in at 1.9. And now the thing is, there's, based on this, for example, Fed Watch Tool, but all those also comments from, and this is, by the way, the same article, you can find it via the Twitter channel here from Admiral Markets. There's several reasons now to go with a very rough approach, but even though one which probably gets the job done most of the time, let's say. So when looking at economic data, usually you wonder, how can I interpret the data to get any more information on this and what to expect then for the markets to happen. And especially when looking at gold as a very yield sensitive asset, it's very interesting to look at U.S. economic data here. For example, inflation rate, but also non-farm payrolls, employment situation, and usually you can now say, after the comments from Bostic, after the comments from Powell, you can say if data comes in below expectation, usually you should expect the US dollar to lose while gold should rise. While on the other hand, if data comes in as expected, respectively above expectation, this is reducing the chance of a rate cut, especially, and then meaning that probably the US dollar can gain some traction, respectively gold will probably see a little backdrop here. And so with this in mind, it will be of high interest to see how this data set will be published. I put it that way, especially if the core inflation rate here comes in at 2%, so below expectation, 2.1%. This could be a driver then for gold higher and initiate the push higher. But, and this is the interesting part, now market participants, after the comments, and especially looking at the Fed Watch Tool, market participants are obviously not expecting the Fed to hike rates, but really to push the US dollar now lower, significantly lower, not only a bit, but really resulting in some momentum which lasts several days then probably, I think it needs more than only a bad data set, but it's more like the conviction that there is not only no rate hike in 2019, but also there's a higher chance than before that there will be a rate cut taking place. And this is now something to definitely keep in mind. So before you now say, hey, I'm aggressively long gold and there's no other way than seeing gold pushing higher. Probably this is true short term, and especially if you make it above 1,300 USD, because such yield sensitive assets are usually also quite stable when it comes to trends, something you can definitely spot on the hourly chart when seeing this push higher over the last weeks now in gold. But on the other hand, the risk reward, the higher we rise without seeing a corrective move here, the risk reward is getting unattractive or more unattractive. It's something to definitely keep in mind here when taking such positions. On the other hand, with the comments from Jay Powell last week on Friday, and seeing the Fed not aggressively hiking rates, on the other hand, in fact, considering rate cuts more likely than rate hikes, this is also giving some solid support for gold bulls. So I'm not seeing a big push lower in gold, and in fact, I expect gold more likely to rise. Which means that, all in all, even though short-term the risk-reward for long engagements in gold probably is getting a little unattractive, again, as long as we trade minimum short-term above 1,275 to 277, I think long engagements are definitely to be favored. And then also the seasonal pattern from next week comes into play. With the ongoing US shutdown, this is an environment which is favorable for gold, and chances are higher, in my opinion, that we're pushing higher than that we're pushing lower. But let's see. We'll have a look at this next week again on Friday then the 18th of January. Let's see how things develop here in gold, and I wish you a nice weekend. Enjoy yourself. Happy trading. Watch your stops. Talk to you again next week on Friday. I definitely look forward to it. See you, and bye-bye.